The stock market is rising. Indices are breaking records. Headlines are screaming markets at all-time highs. People are sharing portfolio screenshots on social media. Green arrows, percentage signs, celebrations everywhere. But what about you? You're still struggling to make it to the end of the month. You're afraid to look at your credit card statement. The money you thought you saved has somehow evaporated. While the stock market is rising, nothing in your life is changing. Same rent, same payments, same financial squeeze. And this question keeps running through your mind. Everyone seems to be winning. Why am I standing still? Who are the real winners? If this question brought you to this video, you're in the right place, because today we're going to talk about exactly this, and not just the problem, but the solution as well. I'm Joe. For years, I've been researching financial systems, money flows, and why the average person can't build wealth. I've spent thousands of hours reading statistics, analyzing economic data, examining household surveys from different countries. From developed nations to developing ones, from salaried employees to self-employed individuals, I've observed the financial behaviors of people across a wide spectrum. And I've noticed something. Most people hear that the stock market is rising, but they can't get a piece of that rise because they don't know the rules of the game. They don't understand who the real winners are and why they're winning. More importantly, they don't know how they themselves can join the winners. In this video, I won't just show you the problem. I'll also share the solution framework that I've seen work through years of experience. You'll understand why you're standing still while the stock market rises. You'll learn who the real winners are. And most importantly, you'll see step by step how you can change this situation. If you're ready, let's begin. First, think about this scenario. Let's say your monthly income is 5,000 units. This could be dollars, euros, pounds, or any other currency. What matters isn't the number itself, but the ratios. From this 5,000 units, 2,000 goes to rent or mortgage. That's exactly 40% of your income. 700 units go to car payments, gas, insurance, and maintenance. 400 units go to grocery shopping. 300 units go to bills, electricity, water, gas, internet, phone. 150 units go to subscriptions, Netflix, Spotify, gym, cloud storage, various apps. 100 units go to transportation, public transit, taxis, extra fuel costs. When you add it all up, what do you get? 3,850 units. You're left with 1,150 units. At first glance, 1,150 units looks good, doesn't it? But wait, that 1,150 units also disappears. A birthday gift for a friend, an unexpected hospital bill, a car breakdown, money for your child's school trip, a cracked phone screen, emergency dental work. At the end of the month, you check your account and there's 50 to 100 units left. Sometimes not even that. Sometimes you're in the negative. And the stock market? The stock market went up 15% during that time. So what did you gain from this rise? Nothing, because you have no money in the stock market. You never had money to put in the stock market. You start from zero every month. The same cycle every month. When you look at household surveys conducted in many countries, you see this. The vast majority of people, 60 to 70%, can't cover an unexpected expense of 500 to 1,000 units. They have to put it on a credit card or take out a loan. And this isn't just in developing countries. In America, Europe, Australia, Canada, the situation is no different. In developed countries, too, more than half of people experience the same financial squeeze. So, you're not alone. But don't let that comfort you, because everyone's in the same situation doesn't mean this is normal. This shows how the system works. And when you understand how the system works, you can act accordingly, winners and losers. Now, I'm going to tell you something that might make you uncomfortable, but knowing the truth is essential for acting on it. Running away from uncomfortable truths makes you their victim. Facing them gives you power. When the stock market rises, the winners are those who have assets in the stock market. It's very simple math, but it gets complicated when you dig deeper. When you look at data from official statistical institutions, you see this. Stock ownership is extremely unevenly distributed. In America, the top 10% own more than 90% of all stock assets. The top 1% alone owns over 50%. In Europe and Asia, the numbers may differ slightly, but the picture is the same. The vast majority of stocks belong to a small portion of the population. So when the stock market rises 20%, 90% of that rise goes to 10% of the population. While you're dealing with your salary, rent payments, and credit card debt, someone else is getting richer while sleeping. While you're stuck in traffic on your way to work, they're sipping their morning coffee, looking at their portfolio, and smiling. But this isn't just about wealth. The real issue is how the system is set up, and understanding this system is the first step to changing it. Think about it. You wake up in the morning, go to work 8 to 10 hours, get your paycheck. Taxes are deducted from that paycheck. Social Security is deducted. With the remaining money, you pay rent, food, transportation, bills. If nothing's left at the end of the month, the cycle starts again the next month. It goes on like this for years. Now think about this. Someone has 1 million units in a stock portfolio. The market goes up 10%. This person gains 100,000 units without doing anything, without lifting a finger, without breaking a sweat, without experiencing stress, in 1 year, while sleeping, while on vacation, while eating. And here's what's more interesting. The tax rate they pay on this gain is lower than the tax rate deducted from your salary. In most countries, capital gains tax is lower than income tax, so you pay more tax when you earn by working. They pay less tax when they earn by sitting. Is this unfair? Perhaps. But I'm not here to tell you the system is bad, there's nothing you can do. On the contrary, when you understand this system, you can learn to play by its rules. You can move to the side of the winners. Maybe not immediately, maybe gradually, but you definitely can. First, we need to understand, why do most people stay out of this game? The first reason is cash flow problems. To invest, you first need money to invest. If you're ending every month at zero, what do you have to put in the stock market? If you can't accumulate capital, you can't earn capital returns. Simple math. The second reason is lack of knowledge. Most people don't know what the stock market is, how it works, or how to invest. It's not taught in school, it's not discussed at home. Fear and uncertainty prevail. People see the stock market as gambling. But when done right, long-term investing is very different from gambling. The third reason is wrong priorities. When some money accumulates, what's the first thought? New phone, vacation, car upgrade, home decoration. So savings turn into consumption, spending for today instead of saving for the future. The fourth reason is impatience. Investing takes time. Compound returns work over years, but people want immediate results. They want to get rich in 3 months. When this doesn't happen, they get disappointed and give up, or they take risky paths and lose. When you look at average data from the last 10 to 20 years, you see this. Broad-based stock market indices have provided an average annual real return of 6 to 8% above inflation. So if you had put your money in the stock market and waited 10 years, your purchasing power would have nearly doubled. If you had waited 20 years, it would have tripled or quadrupled. But what did you do during these 10 years? You spent what you saved every month. Maybe a few times you said, I'll start this month, but didn't start. Maybe you tried once, the market dropped, you got scared, you got out. And 10 years passed. The stock market rose. You stood still. The critical threshold and major traps. Now, I'm going to tell you about a very important concept. I call it the investment threshold. This is the minimum capital amount that can start a real change in your life. This threshold can be different for everyone, but let me draw a general framework. This framework applies regardless of which country you live in or which currency you use. Let's say your monthly basic expenses are 3,000 units. Rent, food, transportation, bills, mandatory payments. In this case, first threshold, 3,000 units. That is, an emergency fund to cover 1 month of expenses. This is your breathing room money. When an unexpected expense comes, you don't have to put it on a credit card. Second threshold, 9,000 to 18,000 units. An emergency fund to cover 3 to 6 months of expenses. This is your security money. If you lose your job, get sick, or something unexpected happens, you can manage for a few months. You can look for a new job without panicking. Third threshold, 25,000 to 50,000 units. This is the level where you can really start investing. Because at this point, you no longer have to break into your investments for every unexpected expense. Your investments can start growing. Fourth threshold, 100,000 units and above. At this point, compound returns start working seriously. With an 8% annual return, 100,000 units earns you 8,000 units per year. Without doing anything, about 650 to 700 units per month, passive income becomes real. Most people can't even reach the first threshold. And that's why they can't break out of the cycle. Every unexpected expense pushes them back. 2 steps forward, 3 steps back. So what do people do when approaching these thresholds? This is where the major traps come into play. Knowing these traps is the first step to avoiding them. First trap, lifestyle inflation. This is very common and very insidious. Your salary increases, your spending increases too. When you were earning 3,000 units, you were spending 2,800 units. Now you're earning 4,500 units, spending 4,300 units. The difference is always 200 units. Nothing changes. Your income is increasing, but your wealth isn't. Sometimes it gets even worse. When your salary increases, your credit limits increase too. You move to a bigger house, buy a more expensive car, take more luxurious vacations, and your debt increases. Your income went up, but you became poorer. Second trap, rushing to spend when savings increase. Let's say you were disciplined for 6 months and saved 5,000 units. And right at this point, an urge comes. I should reward myself. I deserve it. Let me buy a new phone. Let me take that vacation. Let me buy that jacket. And that 5,000 units is gone. You start from zero. 6 months of effort, evaporated in 1 week. This trap is psychological. Your brain sees saving as a type of deprivation. And when deprivation ends, it wants a reward. But this reward is actually the biggest punishment you give yourself. Third trap, focusing on small savings while ignoring big expenses. People try to cut back on coffee money. They save 50 to 100 units per month. They feel good about themselves. But they continue paying 2,000 units in rent. They continue paying 700 units in car payments. Look, I'm not saying stop buying coffee. But do the math right. If your housing cost is 40% of your income, cutting it to below 30% is much more effective than giving up 100 coffees. 10% savings on big items creates a bigger impact than 50% savings on small items. Fourth trap, the minimum payment trap. You have credit card debt. You make the minimum payment every month. Your debt never decreases because interest adds more than you pay. Let me give you an example. You have 10,000 units in credit card debt. Annual interest is 24%. You pay only the minimum each month, let's say 2%, which is 200 units. If you continue like this, how long will it take to pay off your debt? More than 10 years. And you'll pay more than 20,000 units in total. That's twice your debt. This is a trap. And it's deliberately designed this way. Credit card companies want you to make the minimum payment because that's how they win. The more you pay, the more they win. Fifth trap, saying, I don't know the stock market, it's risky. Yes, the stock market is risky. It can drop in the short term. You can lose 30% in a year. But in the long term, historically, it's one of the most reliable instruments for asset growth. When you look at the last 100 years of data, broad-based stock indices have provided returns above inflation despite all crises, wars, and pandemics. Not knowing is not an excuse. You can learn. This video is a start. Sixth trap, perfectionism. I'll start when I have this much money. I'll start when I take that course. I'll start when the economic environment improves. I'll start when the market drops. This perfectionism is a mask for procrastination. There's no perfect time. There's no perfect amount. Starting with 100 units today is better than starting with 10,000 units 5 years from now, because time is the most critical component of compound return. Let me show you the math. Let's say you're 25 years old and start investing 200 units every month. With an average annual return of 8%, how much money will you have when you're 65? About 700,000 units. Now, let's say you waited until you were 35, then started investing 200 units every month in the same way. How much money will you have at 65? About 300,000 units. Waiting 10 years cost you 400,000 units. Without doing anything, just by waiting, you lost 400,000 units. That's why I say, don't wait for the perfect time. Start today. This is how you solve the problem. Now let's get to the solution part. Up to this point, I've explained the problem and shown the traps. But I'm not here just to tell you about problems. I'm here to offer solutions. Through years of research and observation, I've developed a framework that works. I call it the 3-layer money model. Simple, applicable, and effective. Regardless of which country you live in or what income level you're at, this model works. In this model, you divide your money into 3 layers. First layer, the foundation layer. This is your safety net, your emergency fund. Every month, you allocate money here first. The goal is to build a fund that covers 3 to 6 months of basic expenses. This money never goes into investments. It stays in an easily accessible savings account. Interest may be low, that's okay. The purpose isn't returns, it's security. Don't move to other layers without completing this one, because without an emergency fund, every unexpected expense forces you onto credit cards or forces you to break into your investments. Second layer, the growth layer. You move here after completing the foundation layer. This layer is for your long-term investments. Here, the goal is for your money to grow through compound returns. Broad-based index funds, low-cost stock market funds, retirement accounts. It doesn't have to be complicated. The amount you allocate to this layer varies by your situation, but the general rule is at least 15% of your income should go to this layer. More is better. Third layer, the enjoyment layer. This is money you can spend. Vacation, new phone, eating out, hobbies, for enjoying life. But pay attention. You only get to this layer after feeding the first 2 layers. First foundation, then growth, then enjoyment. This order is very important. Most people reverse this order. First enjoyment, then maybe growth. Foundation never happens. And then they stand still while the stock market rises. Step-by-step action plan. Now let me explain step-by-step how to implement this model. You can start today. Not tomorrow, not a month from now, today. Step 1. Calculate your net situation. Take a piece of paper or open a spreadsheet. Write these down. What's your monthly net income? Include all income sources. What are your monthly mandatory expenses? Rent, bills, transportation, food, insurance, loan payments. What are your monthly variable expenses? Entertainment, eating out, shopping, subscriptions. What's your total debt? Credit card, consumer loans, student loans, car loans, mortgage. When you write down these numbers, your situation becomes clear. Maybe you're really seeing it for the first time. You can't manage what you don't know. Step 2. Calculate your debt-to-income ratio. Divide your total monthly debt payments by your total monthly net income. Express it as a percentage. For example, if your monthly income is 5,000 units and your monthly debt payments are 1,500 units, your debt-to-income ratio is 30%. If this ratio is above 36%, your priority should be paying off debt. Why? Because your credit card interest is 24% annually. Stock market returns are 8% annually. If you pay off credit card debt instead of investing in the stock market, you've earned a 24% return, guaranteed, risk-free. Step 3. Build your emergency fund. You've calculated your monthly basic expenses. Aim for 3 to 6 months of expenses. Set aside 10 to 15% of your income for this fund each month. Set up automatic transfers. On payday, money should go to the emergency account without thinking. Completing this fund may take 6 months, 1 year, 2 years. It doesn't matter. What matters is starting and continuing. Step 4. Pay off high-interest debt. List all your debts by interest rate. Start with the highest interest. Every month, pay extra on top of minimum payments. Whether it's 50 units or 100 units, whatever you can. When one debt is paid off, transfer that payment to the next. This way, with each debt paid off, the payment speed for the next debt increases. Step 5. Set up an automatic investment system. Open an investment account. Set up automatic transfers on payday. Every month, a certain amount should go to investments without thinking. For a start, 5 to 10% of your monthly income is a good target. Over time, increase this to 15, 20%. What you buy matters, but consistency matters more. Broad-based, low-cost index funds are a good start. Step 6. Optimize big expenses. Reduce housing costs to 30% of your income. Review transportation. Check subscriptions. These optimizations can save 200 to 500 units per month. 2,000, 400 to 6,000 units per year. With compound returns over 10 years, 40,000 to 100,000 units, the big picture and mindset. Now let's step back and look at the big picture. Why are you standing still while the stock market rises? There are 3 fundamental factors. First, math. If your expenses equal or exceed your income every month, you have no money to invest. You can't accumulate capital, and without capital, you can't get a piece of market returns. Second, psychology. Lifestyle inflation, the urge for instant gratification, avoidance of financial matters, the belief that it's not for me. These keep you in the cycle. Third, the system. Taxes are immediately deducted from salary, capital gains tax is lower, credit card companies want you to make minimum payments, advertisements encourage you to spend. What you can do is understand these 3 factors and act accordingly. Fix the math. Increase your income, decrease your expenses, direct the difference to investments. Fix the psychology. Set up automatic systems. Make decisions in advance. Don't leave it to momentary impulses. Use the system. Use tax-advantaged investment accounts. Understand the power of compound returns. Focus on the long term. Do you know who the real winners are? Those who have joined this journey. Those who started not at the perfect time, but at their own time. Those who started not with big money, but with small money. And those who kept going, you can be one of them too. What's the one thing you'll really change starting today? Ask yourself this question and find your answer. If this model turned on a light in your head, consider subscribing to the channel. Like the video, help the algorithm show this to more people. And write in the comments, what's your situation? Which threshold are you at? What step will you take? I'm Joe. See you in the next video.